John, let's just begin with you, sir. The overwhelming consensus view, and forgive me, I'm struggling to move on from Payrolls Friday, it's Payrolls Monday. The overwhelming consensus view is that we don't have a demand issue, and that was not reflected in the payrolls report. It's a supply-side story. Do you agree with that?
Well, I think you heard some comments in the intro. I think there's a lot of pause that needs to be made here. It's one number. We don't have a good handle on restart dynamics. And when you look at under the hood, I mean, there's a big seasonal story here. Seasonal adjustment where played a big role. If you don't make the adjustment, we had 1 million job created in the month. So we don't know what's the seasonal pattern at this stage in a restart economics. So I'm taking a bit of all of that with a grain of salt at this stage before drawing big conclusions.
Ken, what's your take?
I think the labor market's strong. I think it is a supply problem. I think the weight of the evidence is in some of the details of the report. Average monthly earnings were up 0.7. Okay, that's pretty high, particularly in light of the fact that most of the jobs created were in restaurants and hospitality, which are not the highest paying jobs in the United States. Furthermore, the work week extended, so people are being asked to work more overtime. So I think the weight of the data suggests companies are struggling to hire employees.
So do we have an execution problem? Mike Wilson over at Morgan Stanley weighing in over the weekend. He publishes this morning, and on Sunday, of course, said the following: dreaming about a reopening is much easier than doing it. Goes on to say, given the stocks are discounting mechanisms, it's often better to travel than arrive from an investment perspective. As a result, we think it's time to be more selective and a tad more defensive. Ken, just weigh in. Your reaction to that. Do you think it is a time to be more defensive? Do we face some real execution risk here in the months to come?
Well, the market has, in fact, discounted a pretty robust reopening V-shaped recovery, and a lot of that is priced in. But there are areas of the market that look interesting. I think energy materials look very interesting here. People are underinvested in it because of various reasons. Furthermore, consumer staples are beginning to look more interesting, particularly in light of the fact that they've historically been able to pass through price increases. You know, you're going to buy a tube of toothpaste no matter what the price is. They can go up 10, 15%. It doesn't add a lot to your expense. So I like staples here, I like energy, I like materials. Furthermore, I also like overseas markets. Keep in mind the U.S. Has outperformed this year on the heels of a much stronger reopening. And I would say that Europe is finally getting its act together somewhat on the vaccinations. And I think that the commodity boom and the rest of the world will come along in the next few months. And I think the dollar is also in a little bit of trouble, and I think that could be a little bit of a tailwind. So overseas markets look also a little bit interesting. So rotation might be a good option here. 3
points there. Let's pick up on all three of them. A little bit later in the programme, we'll do the overseas phenomena. So sit tight on that one. On staples, Julian Emmanuel of BTIG is with you. Pricing power, the issue there. The other point that I want to touch on as well, and John, I want your view on this, just the energy story. WTI 65, commodities, iron ore, surging. Singapore futures ripping more than 10% overnight. Copper again, we're on 11K watch at the moment. And yet there are some people that sit here, John, and say, there's reason for pause. Let's reflect, get a bit more defensive, raise some cash. What's your take?
I think the restart is still very much, powerful dynamic that hasn't completely played out yet. As the colleague was mentioning here, hospitality and leisure were up 230,000 jobs in the month. So this is happening. That was the most depressed sector, and so we are seeing that happening. I think that has more to go. So in that context, we are recommending to remain pro-risk in this environment. The restart is continuing. At the same time, we think we should not extrapolate too much staying power for the growth numbers that will be high watering over the next few weeks and months. And as a result, pro-risk, but at the same time, we haven't reset to the beginning of a long recovery. So that I think it's a near-term boost, and we shouldn't read too much into that.